July 27th, 1694. Inside Mercer's Hall in London, a 54-year-old Scottish merchant named William Patterson stood at the center of an idea that had been dismissed for 3 years. Most people who heard it considered it foolish, risky, or both at the same time. Earlier versions had already been rejected by 2 monarchs. The model from Amsterdam was familiar, and few believed England could reproduce it successfully. Yet King William III faced a crisis. For 6 years, he had been fighting France. The conflict consumed roughly $5 million each year. England's traditional methods of raising money for the government had reached their limits. Short-term borrowing from goldsmiths, compulsory contributions, and lottery-based funding schemes were proving unreliable and exhausted. At the same time, France was securing loans more efficiently and at lower costs because Louis XIV possessed a stronger financial system. The charter was approved. The Bank of England came into existence with $1.2 million in starting capital, loaned to the Crown at 8% interest. In return, the investors received a royal monopoly in banking. The Crown gained dependable long-term institutional credit at borrowing costs it had never achieved before. No one present fully understood what had just been created. They believed they were fixing an immediate wartime financing problem. In reality, they were building the system that would enable a single island nation to spend more, arm more heavily, and endure longer than every rival on the European continent for the next 2 centuries. China understood this principle clearly. 15 years ago, it began constructing its own version of the same strategic framework. The importance of the Bank of England is usually explained through monetary history. Discussions often focus on central banking, paper currency, and the lender of last resort function. Those explanations are correct, but they miss the larger story. What made 1694 important was not primarily monetary. It was geopolitical. Before the Bank of England existed, the English government borrowed money from whoever was willing to lend, at whatever interest rate was demanded. Repayment depended heavily on which monarch occupied the throne and whether that ruler chose to honor obligations inherited from a predecessor. The goldsmiths who financed Charles II learned this lesson in 1672. The king halted payments when it suited him. The event became known as the Stop of the Exchequer. About $1.3 million in creditor claims were simply frozen. Those lenders had no meaningful remedy. Confidence in the Crown's creditworthiness suffered for years. The Bank of England changed that situation by placing government debt inside a permanent institution. When the English state borrowed from the bank, it was no longer dealing with isolated lenders. It was borrowing through a chartered corporation supported by thousands of shareholders. Its bonds could be traded in secondary markets. Its obligations were spread throughout England's property-owning class. If the institution failed, financial losses would strike the very people who administered Parliament and governed local counties. As a result, refusing repayment became politically unthinkable. The creditors had effectively become part of the governing class itself. That transformation sharply reduced borrowing costs. France paid between 10 and 12% to borrow. England, after the bank proved its reliability, secured funding at roughly 3 to 4%. Across more than a century of almost uninterrupted wars against France, that gap created a strategic advantage of extraordinary scale. England could fund military campaigns at nearly half the cost faced by France. It could maintain conflicts longer, support larger naval forces, and sustain commitments far from home. France possessed a bigger population and a larger economy, yet it repeatedly found itself outmatched in the financial markets that ultimately determined how long wars could be fought. The Bank of England did not directly win Britain's wars. What it did was make those wars financially sustainable. And over time, wars that could be sustained became wars that could be won. Now consider China. Focus not on appearances, but on the exact strategic role being created. China is not attempting to duplicate the Bank of England itself. It is constructing the kind of mechanism that the Bank of England came to represent. Begin with CIPS, the cross-border interbank payment system. Introduced in 2015, it expanded steadily throughout the decade that followed. Today, it handles international transactions denominated in renminbi for more than 1,400 financial institutions spread across over 100 countries. Most people familiar with it describe CIPS as China's answer to SWIFT. That description is correct, but it does not capture the full picture. SWIFT serves as a messaging network. CIPS performs settlement. It transfers actual funds rather than merely transmitting payment instructions. That difference is important. Because of this structure, CIPS can operate as an alternative financial framework even when Western sanctions remove a participant from systems based on the dollar. In 2022, Western governments froze the reserves of Russia's central bank and disconnected Russian banks from SWIFT. Transactions that continued between Russia and China were routed through CIPS. The process did not function without obstacles. It did not operate at maximum capacity. Yet it continued to work. The financial architecture China had spent 7 years developing passed its first major geopolitical test. This resembles England, demonstrating that the Bank of England functioned during King William's First War. It was not complete proof, it was an early validation. The underlying design had been confirmed. Now consider the critical element. The digital yuan, known as the ECNY, is not mainly designed as a domestic payment platform. From its foundation, it has been structured for cross-border applications. Its framework allows integration with other central bank digital currencies through the M-Bridge project, which already involves the central banks of China, Thailand, the UAE, and Hong Kong. The BIS, the Bank for International Settlements, supplied the infrastructure used during the project's development. The objective is clearly stated: enable transactions between central bank digital currencies across national borders without passing through any correspondent bank operating within a dollar-denominated system. Once that infrastructure reaches large-scale operation, any country seeking to purchase oil from Saudi Arabia, copper from Chile, or semiconductors from South Korea without relying on dollar-based networks will possess a practical alternative. It will not be flawless, it will not necessarily be cheaper at the start, but it will function. This is the equivalent of creating a funded national debt. It is the institutional foundation that converts geopolitical potential into financial capability. At this point, the comparison with Britain in 1694 becomes more than a simple analogy. The structural similarity becomes precise. The breakthrough behind the Bank of England was not technological. Many people in 1694 already understood banking. Amsterdam had been demonstrating the model for nearly a century. The true innovation was institutional. A framework was created in which the creditors of the English crown possessed enough political influence that repudiating debt became structurally impossible. Government obligations became durable and dependable, not merely because of legal enforcement, but because the interests of creditors became aligned with the preservation of the institution itself. China's financial infrastructure expansion follows the same principle in reverse. Its objective is not to make Chinese debt more dependable for foreign lenders. Instead, it seeks to make other nations sufficiently connected to Chinese financial infrastructure that those nations develop a structural interest in the continued growth and survival of the system. The Belt and Road Initiative has provided approximately $1 trillion in loans to developing countries for infrastructure development. A significant portion of those loans is denominated in renminbi. Many projects are structured around Chinese contractors, Chinese equipment, and Chinese technical standards. The nations that borrowed and constructed these projects are not merely debtors. They have become participants in a financial and technical ecosystem whose continued expansion advances their own interests. Sri Lanka, Pakistan, Ethiopia, Indonesia, Malaysia. These countries are not shareholders of the Bank of England. Yet, in an important functional sense, they occupy a similar position. They possess a structural interest in the continued operation and growth of China's financial system. That mirrors the role played by Britain's landed gentry in 1694 when they contributed capital to establish the bank. They were not acting out of generosity. They were practical participants who recognized that an institution they financed would also protect and advance their interests in the future. There's another aspect that financial media rarely presents in this way. It is the competitive dynamic that makes China's version of a 1694 moment significant for every nation whose trade remains denominated in dollars. England in 1694 was not attempting to dismantle Amsterdam's financial network. Its objective was to construct a comparable system that advanced English strategic goals rather than Dutch ones. The success of the Bank of England eventually moved the center of global finance away from Amsterdam. That shift did not occur through conquest. It happened through the steady buildup of financial infrastructure, institutional trust, and the strategic advantages created by lower government borrowing costs. China is not seeking to eliminate the dollar-based system. Instead, it is developing infrastructure designed to serve Chinese strategic priorities rather than American ones. As time passes, countries that adopt those systems gain additional reasons to continue using them. The pattern resembles what occurred during the 18th century, when nations conducting business through London increasingly oriented themselves toward London instead of Amsterdam. The dollar's position as the world's reserve currency is supported by network effects. It remains the standard because nearly everyone uses it, and nearly everyone uses it because it remains the standard. Network effects are powerful, but they are not permanent. They can be challenged through patient and sustained development of alternative infrastructure that becomes useful to a sufficient number of participants. England required approximately 50 years after 1694 to fully replace Amsterdam as Europe's primary financial center. The transition was not dramatic. It unfolded gradually, one transaction at a time, and remained largely unnoticed until the process was already complete. China began building in 2015. It has now spent 10 years on that effort. The infrastructure remains unfinished. Its credibility has not yet been fully established. But the framework exists. The geopolitical pressures encouraging countries to use it also exist. The sanctions risk demonstrated by Russia's experience in 2022 made that reality tangible for every country with adversarial, or potentially adversarial relations with Washington. Those pressures are becoming more significant over time. People were not discussing these implications in 1694 either. Their attention was focused on King William's War. The deeper architecture was largely overlooked. William Paterson's proposal was ridiculed for 3 years. The charter establishing the Bank of England received approval on a Tuesday in July 1694. At the time, the financial publications of that era described it as an interesting experiment in government finance. Few suggested that England had just created the mechanism that would support its rise as the dominant global power for the next 2 centuries. Today, China's CIPS network, digital yuan system, and Belt and Road lending framework are often described as interesting experiments in financial sovereignty. Few are arguing that these developments could become the mechanism capable of challenging the dollar's reserve currency position during the 2040s. Yet the architecture is already in place. The first major test has occurred. The network continues to expand. The question remains centered on credibility. The achievement of the Bank of England depended on confidence in the institution. It depended on proving that the English crown would honor its newly institutionalized obligations rather than defaulting on them. China's financial infrastructure faces the same requirement. Its long-term success will depend on whether comparable credibility can be established. As these systems continue to evolve, the answer to that question may determine whether today's financial architecture remains unchanged or gradually shifts toward a new center of gravity. If this analysis gave you a new perspective, follow for more discussions on the structures that shape global power long before their effects become obvious.